Bonds Part 1, Introduction to Bonds Payable versus Notes Payable, Overview of Bond Terms, and finally the accounting for the issuance of bonds. Let's start first with the introduction to bonds payable. What are bonds payable basically? They are very common form of long-term liability. We are going to discuss few terms that will explain bonds payable in sufficient detail. Bond indenture. Bond indenture basically it's a legal contract between the company, the issuer, also called the borrower, and the bondholder, the company or the investor who is investing, also called the lender. So basically bond indenture, it's a contract between the company and the investor detailing the terms of the bond. Face or par value. Face or par value basically it's the amount to be repaid at maturity. And that's the amount on which we calculate the interest payments, right? So bonds are issued at par if the stated rate and the market rate are the same. We'll discuss it as we proceed. Stated nominal or coupon interest rates. These are the fixed rates of interest which are mentioned in the bond contract, and this interest is to be paid periodically to the investors, those who invest. Market interest rates or effective interest rate. This is the rate of interest which the investors actually earn based on the current market conditions. We'll discuss it later on. Discount. This occurs when let me just give you it in tabulated form so it will be more meaningful for you. If your coupon rate is equal to the market rate, the bond is issued at par. You get $1,000 for a $1,000 bond. If coupon rate is less than the market rate, let's say if the coupon is 6%, the market rate is 8%, your bonds sell at a discount. Maybe a $1,000 bond sells at $850. Right? We'll discuss it in detail. And when your coupon rate 6% is more than the market rate, in that case your bond sells at a premium, right? The $1,000 bond may sell at $1150, $1130. That's just the idea. So this is what the idea is: discount, premium, and we'll discuss it in the coming slides. And for basic understanding, bond discount means when the bonds are sold below the effective market rate. The market rate is higher, your coupon rate is lower, so investors pay less amount for the bond. When the bond is offering a higher rate than the market rate, bonds are sold above the face value because investors are willing to pay more for such a bond that is offering a higher interest payment. That's the basic idea. These are the types of the bond. Debentures are bonds, but they are unsecured, means which do not have any specific collateral. Mortgage bonds, these are secured bonds, secured by real property as collateral. Then we have collateral trust bonds. These bonds are secured by other financial assets like stocks and bonds. Convertible bonds, these are the bonds which can be converted into issuers' common stock. Then there are two types within them: non-detachable warrants and detachable warrants. Non-detachable warrants means warrants which give you the right as an investor to convert your bonds into common stock. So when they are non-detachable, that means they must be converted into stock with the bond. And detachable warrants means they allow separate trading of the bonds and warrants, so mean they can be treated separately. Participating bonds, as the name suggests, that these bonds they do get stated interest payments, but they also share additionally in the earnings of the company if earnings reach a certain level. Term bonds, as the name suggests, they have a timing. They mature on a single fixed date, and on that date we repay the entire principal at once. And just opposite of this, we have serial bonds which redeem in portions over time. Term bonds redeem in full in a single payment, whereas serial bonds, they redeem in portions, 10%, 20% later on, then 30%, often annually, right? And finally, we have income bonds. These are the bonds on which interest is only available to investors if the company that had issued these bonds, if the company achieves certain specific income targets. If company that issued its bond did not earn enough, there is no interest. For this reason, income bonds will carry a higher coupon rate. Zero coupon bonds, as the name suggests, these bonds basically they don't carry any interest, and then why would you invest as an investor in such a bond? Sometimes these bonds are called deep discounted bond. The bond is available at $700 and matures by paying you $1,000. There is no interest payment. So the difference between what you paid versus what you got, this $300 effectively is your interest income as an investor. Commodity backed bonds, these are the bonds which are redeemable either in cash or for a specific volume of certain commodity. whichever is more valuable. Bonds versus notes payable. Implementing instrument. Bonds are issued through formal bond certificates. Notes are issued through formal promissory notes. Definitive agreement. It is governed by a document called an agreement called bond indenture that contains terms and conditions. In case of notes, it is governed by loan agreement tailored to the lender and borrower specific needs. So it is customizable, but this is not. Face amounts generally $1,000, and it can be anything between parties based on the terms. Term 10 to 30 years. It can be any flexible and negotiated based on the agreement. Then payment prior to maturity. In case of bonds, often pay only interest before maturity, but in notes, payment can include principal and interest because it is negotiated individually. Payment at maturity. Bonds often pay only the interest before maturity. Full amount is made available at the maturity of the bonds, whereas in case of notes, payment structure is flexible and can be negotiated. Number of creditors, many. Many investors invest in bonds, sometimes in millions, whereas notes usually involve one or few lenders. Publicly traded bonds are publicly traded, yes, in public markets, but notes, they are not. Secured bonds can be secured, yes, they may be, but they may not be always. Like mortgage bonds are secured, debentures are unsecured, but notes on the other hand, they are typically secured through specific collateral. Registered, yes. Issue in the name of the holder. The bonds are issued in the name of those who invest. So this is recorded in the issuer's records. And notes, yes, they are also issued in registered form with the lender details specially mentioned. Bearer form. Bearer means bonds can be transferred to another person. Transferable by possession. Those who hold the bonds, they get interest. But notes are not in the bearer form. Rights of debtor to call or prepay, yes. So it is yes in both cases. Right of creditor to put without default means the creditors can demand early repayment of bonds under certain conditions. So this is possible in bonds, but in notes, creditors do not typically have this right under the notes. So that is the table that highlights the differences between bonds and notes. Just have a quick look at it. Overview of bond terms. We have already discussed that bonds are a long-term liability which are reported on our financial statements at their face value, less any adjustment for unamortized discount and premium. We'll discuss it as we go along. Denominations of $1,000 means bonds are typically issued in standard increment of $1,000. Price quoted in hundreds means bond prices are expressed as a percentage of their par. If you see bond is priced at 102, it means it is 102% of par. And if par is 1,000, that means the price of the bond is $1,020. Similarly, if it is priced as 98, that means it is 98% of par. That means it's priced at $980. That is the idea. Indenture contract, we discussed this earlier. It's a legal agreement between the investor and the issuer. It outlines the terms of the bond, which you need to know. Coupon rate is the rate, fixed interest rate stated in the bond. It is sometimes also called the stated rate, because this is the rate we will use to calculate the periodic interest payment. Bond interest calculation is fairly straightforward. You simply take par and you multiply it with the stated rate. That is the interest payment calculation. Principal payoff. Principal payoff basically is the par value of the bond, the face value that is repaid in full at maturity, regardless whether it was a discounted bond or a premium. Premium discount adjustment we'll discuss shortly, because sometimes your bond sells for more than par, sometimes it sells for less. So this results in premium and discount, and this premium and discount adjustment amortization we are going to discuss shortly. Next, we have accounting for the issuance of bonds. Bond selling price. Bond selling price is calculated this way, which is also called the value of the bond. It's equal to present value of interest payments, cash payments, plus present value of principal. So these interest payments and this principal, it is discounted at the rate that was prevalent in the market on the date of the bond issuance. So please remember, bond selling price is the present value of interest payments and present value of principal. Now we are going to discuss it in different cases. What is the bond selling price if it is issued at par? What is the bond selling price when it is issued at premium or when it is issued at discount? Let us see. Assume that Christie Corporation issued a 10% $1 million bond due in 5 years. The bond were issued on January 1st. The interest is due on June 30th and December 31st. The yield or market rate is also 10%. Now, first of all, it's a 5 years bond but paying interest semi-annually. We will be using these discount and annuity factors, but let us first make sense out of it what we have at present with us. We have a bond that pays a 10% coupon, and the market rate when it was issued was also 10%, but that means your coupon rate is the same as the market rate. So the bond will fetch exactly $1 million, and I will tell you how. 10% of 1 million, that is $100,000 interest every year. Since interest is paid on semi-annual basis, June 30th and December 31st, that means $100,000 upon 2. 50,000 is paid on June 30th each year and 50,000 in December. And this is what it is: June 30th, 31st December, June, December, June, December, and it goes on for these 5 years. How many payments are there? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So there are 10 payments of 50,000 each, right? And at the same time, we will be paying the principal back to the investors by 31st of December, year 5. So the bond discounting, I told you, is done at the prevalent market rate, which happens to be, interestingly, the same as the coupon rate. Since this rate is on annual basis and we pay interest every 6 months, so we have to divide this interest payment rate with 2. That means your coupon is 5%, which is 50,000 we just saw, and your effective rate will also be 10 upon 2, 5%. So the point is, we will be discounting bond this way. The value we receive by selling the bonds is $50,000 paid every 6 months multiplied by annuity factor for 10 periods at 5% plus $1 million, which is the principal, multiplied by the discount factor for 5% for 10 periods. 10th period, right? So you just plug in it, you will find the present value of the bond, which is the amount you will collect when you sell this bond issued at par. Let's see. 5% for 10 periods, this is it, 7.722. We will use this for the purpose of discounting interest. It is already given to in the same question. I just want to show you how do you find these numbers from the present value tables. And discount of principal 5% for the 10 periods, 0.614. They are given in the same question. Let me show you. This is the annuity factor and this is the discount factor we will use. So just plug it in. Annuity factor for 5% 10 periods, this is 7.721735, and discount factor is 0.613913. So this multiplied by this plus this multiplied by this should give you the amount. Gives you exactly $1 million. This is the bond issued at par because your coupon and the market rate, they happen to be the same. So as a borrower, you debit cash, credit bond payable, and if you are an investor, you made an investment in bond, debit cash credit. Now let's say it's a discount bond, bonds issued at discount. Assume that Christie Corporation issued 10% 1 million bonds due in 5 years. The bond were issued on January 1st, interest is paid June 30th, December 31st. The yield or market rate is 12% on the date when the bonds were issued. Determine the selling price of the bond, noting the amount of discount or premium, and prepare the journal entries for the borrower and investor to record the bonds at issuance. Okay, interest payments are the same. June, December, June, there are 10 such payments, and on maturity we pay the full principal amount, right? Now the next part is discounting. 10 interest payments to be discounted at the market rate. Remember, discount is done at the market rate, not the coupon. So 12 upon 2 because it's a semi-annual bond. And we do the same thing 1 million times discount factor for 6% 10 period. Plug it in, you will find the number. This is the PV annuity factor, 6% 10 periods, and this is what we are going to use as discounting for the principal for the at the end of the 5th period. So these two discount factors would be used to find the value of the bond. Here is the calculation given. 50,000 times 7.360087 and 1 million times 0.5583. So if you add these up to, you get 926,399. Clearly, you receive less than the face value of the bond. That's because your offered rate is 10%, whereas the market rate is 12%. So your rate is lower, so the bond sells at a discount. So what is the journal entry relating to this transaction from both perspectives? From borrower's point of view, debit cash, debit discounts on bonds payable, which will be amortized over the next 5 years, and credit bonds payable. From investor's point of view, investment in bond debit, that's what he paid, and credit cash. Simple. Now, if your coupon is higher than the market rate, the bond sells at premium. Assume that Christie Corporation issued 10% 1 million bond. During 5 years, the bonds were issued on January 1st, interest is paid on June, December, same, but yield or market rate is 8%. Your offered rate is higher than the market rate. Coupon is higher than the market rate. Determine the selling price of the bond, noting the amount of discount or premium. Prepare the journal entries and investors for investors and borrower to record the bonds at issuance. Idea is very simple. You are going to divide 8 with 2, 4%. So you're going to use the annuity factor for 4% for 10 periods and the discount factor for 4% for 10th period. And you multiply the interest payment with the annuity factor and the principal with the discount factor. You get 10810,81109. That is 1.081 million. You got more than the face value. The reason your offer rate is higher than the market rate. Resultantly, it results in premium. So you debit cash, credit bonds payable, and credit the difference between what you got versus what is the liability. That's called premium bonds payable. And as an investor, you debit investment in bonds and credit cash. Stated interest rate. This is the fixed interest rate printed on the bond, and it is set before it is issued, and it is also mentioned in the bond indenture. And please note, it doesn't change. The stated rate remains constant regardless of the fluctuation in the market interest rate. And this is the rate that we use to calculate the interest payment. Bondholders receive regular interest payment based on the stated rate that is applied on the face value of the bond. And what about the payment frequency? How many times? As we discussed in the previous examples, interest is typically paid semi-annually, that is twice a year, while interest expense accrues monthly if you are preparing monthly accounts, or you may prepare it on annual basis. That is not specific issue here. Effective interest rate. What is effective interest rate? The actual market rate of interest that the investors earn for the bond of similar risk issued at the same date. So this is not the coupon rate. There is a difference. Effective interest rate is the rate that is available in the market on similar bonds that what the investors actually earn. So what is market adjustment? The bond issue price that we discussed in the previous example, it adjusts to align with this effective interest rate. We use this rate to calculate the interest rate. I'll explain it later. So it requires some adjustments to calculate the discount, amortization, and premium amortization. That's the idea. So bond issued with a stated rate more than the effective rate, that will sell at a premium, and the bond issued at a rate that is less than the effective interest rate, it will sell at a discount. We discussed this earlier. And finally, what is the purpose? The purpose is that it ensures investors receive the similar rate of return in the market irrespective of the bond stated rate. Discount, we just discussed that a little ago. What are discount? Discount occurs when your stated rate is lower than the market rate. So resultantly, what happens? Your bond sells for less than their face value. We just saw that in an example. So how do you calculate interest expense? We take the book value, the carrying value of the bond, and you multiply it with the effective rate. That's how we calculate interest. And interest payment is calculated by taking your stated rate times the par. So the difference between what you got versus what is the face value, this reflects the discount. The difference between the bonds, amount you received, and the face value of the bond. Unamortized discount, basically it is the contra account that reduces the face value. Let me show you. This is the face value of the bond, less discount on bonds payable, this less this 926,399. This is the net amount we report as bonds payable on the balance sheet. So this is how it's presented. That is the face value less the unamortized discount, 73,601, and that's the carrying value. And this discount, 73,601, it is amortized over the life of the bond using effective interest rate method. We discussed this earlier in the notes payable. Similarly, premium occurs when the stated interest rate is higher than the market rate of interest at issuance. So this will result in extra amount received when the bonds are issued. So this 81,109 is the unamortized premium. So how do we report it to the balance sheet? Bonds payable plus unamortized premium. This unamortized premium is reduced over time, and this amount that you see is called the carrying value of the bond. So this 81,109, it's keep on amortizing over the next 5 years. By the time the bond matures, it will have exact 1 million value at the maturity. So face value plus unamortized premium, which keeps on reducing, the carrying value will become face value by the end of the term. And same goes for the unamortized discount. It becomes 0, and face value and carrying value, they are the same at maturity. If the stated rate and the market rate is the same, there is no discount or premium, your carrying value stays the same throughout the life of the bond. But in case if your stated rate is less than the effective market rate, then your bond sells at a discount, and this discount gets amortized every year. This is how it's done. This is the carrying amount times 8%. That is the interest expense, goes to income statement. That's what you pay. The difference between these two is the discount amortization. So 88,021 plus 2041, 90. Next year, the interest is calculated on this amount, but paid at 5,000. The difference is the discount amortization. This amortization keep on adding in the carrying amount. By the time the bond matures, you have the exact $100,000 balance in the bonds payable. Same goes for premium. If you're offering a rate 8%, which is higher than the effective market rate of comparable risk and terms, resultant your bond sells at a premium. So you pay interest at the rate of 8% coupon, 888 every year, but interest expense is calculated by taking your carrying value times the effective interest rate. So the difference between interest paid versus interest expense is the premium amortization. This premium keeps on reducing the carrying amount of the bond. By the time the bond matures, it will show exactly the face value at maturity. Next, we have bond issuance cost. What is bond issuance cost? These are the costs that we incur during the issuance of bonds, like legal cost or accounting cost or underwriting cost, the underwriters who help you sell these bonds. So what do we do with this cost? It is treated in the same way as bond discount. This is what we do in case of a discounted bond. We report it net of the discount. Same thing goes for the bond issuance cost. The bond issuance cost, it is shown as a direct reduction from the carrying amount of the bonds. The way we amortize discount on the bond, we amortize the issuance cost in the same way. On December 31st, year 1, Christie Corporation issued 10% 1 million bond due in 5 years. Interest is due on June 30th and June 31st. The yield or market rate is 12, and the bond was sold for this amount. Bond issuance cost was $20,000, and the effective interest rate is 12.58. Prepare the journal entry to record the bond issuance and indicate how the bond should be reported on December 31st, year 1 balance sheet. Now we are incorporating the bond issuance cost. This is in continuation the same question we did earlier for discounted bond. So this is the bond discount. We paid $20,000 for bond issuance cost. So this 93,601, this is reported as a discount on bond issuance cost. So this 20,000 issuance cost is combined with it, and it is amortized in the same way as the discount on bond issue. So this is how you report it on the balance sheet. Principal less unamortized discount and bond issuance cost. That's what you report as a carrying amount of your bond. Deferred bond issuance cost. What is it? Sometimes we pay issuance cost before the bonds are actually issued. So since these costs cannot be charged as an expense to income statement, so we defer them on the balance sheet until the bonds become a liability. So it says on November 1st, year 1, Christie Corporation incurred bond issuance cost of $20,000 related to bonds issued on December 31st, right, for 926,399. So prepare journal entries to show how these are recorded. So we debit deferred bond issuance cost. This doesn't go to income statement, credit cash. Once the bonds are issued, we incorporate these into the accounting record. We remove it from deferred bond issuance cost by crediting it, and we add it to this account discount and bond issuance cost. Idea is straightforward now.